Hi, and welcome to this session of Mind of the Manager with Ford Asset Management. I'm Linda Eedes, and I'm joined today by my colleagues, Nick Balkin, who is the Chief Investment Officer of South Africa, and Wim Murray, who's one of the portfolio managers for the Ford Equity Fund. And the topic for today's webinar is A New Dawn for SA Incorporated, ? So we're going to be exploring some of the issues that we need to take into consideration when we're investing in local equities listed on the Johannesburg Stock Exchange. We're going to be discussing some of the macroeconomic considerations which factor into our analysis of such businesses. And then we're going to be taking a look at some of the businesses that we invest in, considering some of the criteria that we look for in those companies. Now, for the last decade, companies have really had to swim against the tide to actually grow their earnings. And we're very lucky that we have many businesses that have actually been able to do that regardless. We've had a lot of curveballs for businesses along the way. So, of course, I don't need to remind everyone of the energy shortages that we've had over the last few years, failing infrastructure, dysfunctional railways, blocked ports, high interest rates, and, of course, a very volatile rand as well. So for the past decade, we've actually seen very little economic growth coming out of South Africa. In real terms, South Africa has only grown by about 1% per year, which means that actually on a per capita basis, that means per person, we've actually been getting poorer. Now, with that backdrop has also been a lot of unstable politics. But recently, it seems we may have turned a bit of a corner. So certainly the markets reacted very favorably to the announcement of the Government of National Unity recently. So the question mark is this the new dawn that we've been waiting for with regards to South African investments? Now, you may be aware, if you're familiar with Ford Asset Management, that we have a top-down element to our investment process, which considers things like, for instance, the macroeconomic backdrop and some of the top-down drivers. And we marry that with a bottom-up valuation-driven process, which considers the price that we are willing to pay for the future earning streams of the businesses that we like and want to allocate your capital to. So what we're going to do today is Nick is going to actually walk through some of those issues at the top-down level that we have to consider. And some of those issues actually extend beyond South Africa. Of course, at the moment, all in the news is the US elections, the possibility of Trump 2.0. And we need to think about what that means for us down here at the bottom of Africa. And Wim is actually going to walk us through some of the examples of businesses that are finding their way into the portfolios. And the point of that is really to give you a good sense of the amount of work that actually goes into and the criteria that we use to identify businesses to allocate capital to. And of course, considering the price that we are willing to pay for that. But first, it would be remiss of me not to talk about the performance of the Ford Equity Fund. Now, this Ford Equity Fund invests only in SA equities. It is managed by both Nick, Wim Murray, and Nancy Hossack. And if you actually look at the performance on the screen there, this measures the Ford Equity Fund's performance after fees. This is the most expensive asset class in terms of the fees that are paid. So it's an after fees number versus the CAPI, which is, of course, a measure of the market. And you can see that over the last few years, the portfolio managers have done a really phenomenal job. The three of them have been managing the Ford Equity Fund over the last 3 years. But of course, this fund actually goes back more than 20 years. And that's one of the things that I think is quite rare in the South African marketplace, to actually find asset management businesses that have been managing the same funds for more than 20 years. So it does have significant longevity, which I think speaks to the staying power of the process that we use here at Ford. But you see that over 3 years, it's delivered just shy of 13% per year after fees. And I think if you consider that over its long-term track record, it's delivered more than 8% above inflation per year for the investors that have been invested in this segment. It really is testimony to a process that has worked well over time. And hopefully today you're going to get a little bit of an idea of how we actually do that and the combination of assets that actually find their way into this portfolio. And of course, not forgetting that this also, in terms of the ideas that are generated within the SA equity landscape do make their way into our multi-asset funds, which are able to invest not only here in different asset classes, including SA equity, but also in a range of asset classes offshore as well. Now, we believe that we're in an environment that actually plays to our strengths. One has to consider the macroeconomic factors at play. There's a lot going on, as we know, but also security selection is absolutely critical in this sort of market backdrop. Now, we're going to be doing a Q&A after Vim's section. So if you have any questions, do pop them into that Q&A button that you see on your screen. We'll be checking those, but we also did ask for questions when you registered for this event. So we did get a lot of questions that came through. Thank you to those of you who did submit questions, and we're going to be addressing some of those to Vim and Nick later on in the session. But let's talk to some of the bigger themes that we're considering. So over to you, Nick, to do that.
Thank you, Linda. And thank you, everyone, for joining us. Yeah, elections everywhere. I think we've had elections in France, we've had elections in the UK. I think the biggest one up and coming, we've also had elections obviously in South Africa. The up and coming election in the US is key. I think there's a high probability that Donald Trump does become the president in the US, and I think we have to consider the implications since the US is the biggest country in the world and a lot of people take reference of it. We think this time it's going to be much harder for Donald Trump to make a difference in the US and to continue the growth that they've seen more recently. We do think that it's a lot more mature, the economy this time around. I have a few charts on that a bit later that I'd like to take you through the detail. I think talking about the US economy, the problem is for them is that the leading indicators are actually showing weakness. There's the auto loans and the credit card loans. Both of them are showing signs that the impairments are ticking up. There's a lot of talk around inflation coming down and interest rates coming down and that providing the respite for the US economy. Unfortunately, the biggest driver for the US economy continues to be the 10-year bond. So although interest rates might come down a little bit, the biggest driver for mortgages should remain above 4%, and therefore the consumer shouldn't receive as much respite as people are expecting. Turning to China, I think the regulatory overhang is easing. However, it is taking much longer for the property bubble to deflate. I think importantly, for the long term, we do think that the valuations are low, which does provide an opportunity for long-term investors. When it comes to South Africa, I don't need to remind anyone that there were a fair amount of outcomes that could have happened at our election. We would call it a market-friendly election result that took place. Having said that, markets are discounting entities, and both the bonds in South Africa and the large cap equities are now pricing in a fair amount of that election euphoria. For us, the next leg of the growth needs to come from the coalition holding together, but importantly, to have sustainable growth above 1.5% to 2% to see the equity market kick further. The opportunities for us remain, as I said, because the large caps have largely moved up, in the small and mid cap shares. And then looking ahead from a positioning point of view, gold provides a good stability or insurance plan should the outlook that I provided not pan out. So let's turn to a bit of the detail. When it comes to the US consumer, actually, interestingly enough, the US consumer is in a very strong position. The chart on the left is the US consumer net worth to GDP. What does that mean? Effectively, that is the assets or the net assets of the overall US consumers to GDP. So one item shows that the assets have grown, as you can see from the chart, about 10 years ago, from around 4 to 4.5 times the GDP to over 6 times the GDP. That is a huge amount of growth in the net assets of the overall US consumer. Coupled with that, you see on the other side of the chart, the US household debt has come down from almost 100% to 75%. So those two metrics alone show you that the consumer is actually in a good position. In fact, if you're in the top 10% of the US consumers, you're feeling pretty chipper about life, even where interest rates are. So why aren't we more positive about the US economy? I think one of the key reasons is the two biggest asset classes that make up the net the net worth that I showed you on the previous chart are the house prices or the house assets and also the S&P. Both of these you can see without too much trouble are operating above their long-term trends. From the housing market, you can see the red line is the long-term trend line versus the blue line, which is significantly above that, almost double 10 years ago's house price. On the other side, the S&P, which is the dark line, has, as you can see, doubled and doubled again almost. The best way to explain the overall S&P valuation is to look at the red line on that chart, which is the price to earnings valuation that the S&P would be at a 19 times price to earnings. That is a very high number already relative to history. And as you can see, we're operating significantly above that. We wouldn't be surprised for that dark blue line to trend to the middle of that chart or the middle band over time at some point. So therefore, although things are looking pretty rosy from an asset point of view and the debt has been paid down, we are concerned that the two biggest drivers will probably be tepid growth from here at best. And therefore, we know that when people are making money and have better assets, they have more confidence, just like that Chinese economy that I've spoken about, that with the bubble being pricked. We do think that the animal spirits do have a potential that we don't have that confidence coming through in the US, and it actually becomes a headwind rather than a tailwind that the assets have provided previously. And I've always said in presentations that I do that the biggest thing is that we don't have a US government that's in position to help the US consumer out this time. We're entering the next mature economy with over 6% budget deficit. That means that the US economy is spending $106 for every $100 they take in taxes. They just don't have the ability to bail out the US economy and the US consumer again. Every time I look at this picture that we put it together is a pretty scary picture, not only from this data, but the picture behind it. We have to look at and consider Donald Trump, as I said, coming into the presidency. I did show you quite a few of these data points already, but it's good to put it in numbers. The S&P has absolutely doubled over the last time that Donald Trump was president, and you can see that the PE ratio has gone from 18 times to almost 25 times. The house market is almost near doubled, and we're entering this next potential Donald Trump presidency with a 6% budget deficit. Not only that, he's cut corporate taxes when he was president down from 35% to 21%. So all of those things give him less flexibility to continue to pump the overall US economy. That doesn't mean he's not going to try. Donald Trump does love growth, and he will do probably whatever it takes to try and maintain that growth. So for planning purposes, you'd expect more tax cuts potentially, and more spending and more tax cuts, and probably a little bit more spending also. All this means that inflation might stay a little bit higher than most people expect if we do have a Donald Trump presidency. Turning to South Africa, as I said at the beginning, I think one of the key parts is it's our job as portfolio managers and custodians of your money to make sure that we're protecting for all the outcomes, not only the outcome that eventuated. I think this is a fairly self-explanatory chart, just to explaining that there was significant downside to markets if other outcomes played out. So we needed to make sure that we had a very balanced overall portfolio to protect if the overall better outcome didn't come through. Having said that, from a positioning point of view, we were more tactically positive leading into the election. I think one of the key metrics that we're showing on the charts today is the resumption of the performance of Eskom after a very poor performance over the last few years. What we were hearing in the news as we're heading into the election is that it was just electioneering, that Eskom was pumping the diesel and overall pushing the plants to keep the power on. When we dug into the detail directly from the Eskom database, we could see that it was actually more than that there was a structural change going on at Eskom. As you can see from the chart, the energy availability factor was in the 50s and it moved up to 63 on the current period. So that's actually updated to June this year. But last year, when we were in the depth of the level 6s and 5s crisis, you can see the difference it made when we were only operating in the 50s. Importantly, an energy availability factor shows you what percentage of the plants at Eskom are available at any one time to produce power. When you only have 50% of the plants working, we know that that's not going to be a sustainable outcome. So importantly, you can get to that energy availability factor by two methods. You can either cut the planned capacity to make sure that you're doing the maintenance, or you can improve the ongoing capacity and reduce the unplanned capacity loss. That means that you're just improving the general breakdowns at Eskom. As you can see from the red line, and it correlates with the previous year where we were only at 50% energy availability factor, we had 17,000 megawatts that were out for unplanned maintenance. That's not good. When it comes down to this year, and we've pushed it all the way to June, the unplanned is down at 11,000. In fact, to July, Eskom are reporting that that number is 10,000. I did put the blue line there also to show you where unplanned needs to go for us to resume level 2 outages. So importantly, it's about digging in the numbers. We did get the facts that things were improving, and I think it did give us some confidence to take a tactically more positive outlook on South Africa. It's one thing to say that we felt that way. It's another thing to think about what we actually did. This is the forward equity fund cash from the beginning of the year. So we started off with around 11-12%, and as we led up to election, there was no need for us to rush and spend that cash. As the market started to sell off, I guess there was a bit of elections jitters, which we expected, combined with the fact that we were tactically more positive, meant that we put a fair amount of that cash to work, from 14% down to 5%. We reinvested a lot of that into South African incorporated shares. So what does that mean in numbers? You can see that looking at a year ago, July 23, in the inside circle, that shows you the previous year's positioning of the overall SA equity fund. Only 37% of the overall fund was positioned in South African incorporated shares, and that has moved up to 52% as we speak a few days ago. From an overseas perspective, it came down slightly, but as I said on the previous slide, we spent a fair amount of that cash from 14 down to 6. The additional 1% is obviously the gold ETF in that chart. That makes it different from the previous chart. From a resources point of view, we largely stayed around the 11% mark. However, digging into the detail of that 11%, it's a very different mix this time around. Starting the chart at 2023, which is just over a year ago, more than 80% of the overall resource weight was in the grey bar, which is the general miners, your Billitons and your Anglos. As time has passed through the year, we have been more positive on the precious metals, especially the golds. As the gold price technically looks stronger and the gold shares didn't reflect that, we started to position a few percent of the portfolio in gold ETF, followed by the gold stocks. We also have a small allocation to the PGM miners. So I think it is important sometimes you see a number that stayed the same, but there's a lot going on under the hood. So I spoke about the tactical side of things. I think it's also important to think about the future and how we are from a positioning point of view in the future. As I said, importantly, to sustain that growth is the most important thing. We need growth not for 1 year, not for 2 years, but for the long term. For now, the GNUs are positive, but I think this chart illustrates that it's not all plain sailing. Although the DA did get 30% of the overall votes in the overall GNU, they only got 19% of the ministries and 14% of the deputy ministries. And importantly, the Gauteng area is still not resolved from a GNU point of view. So let's just say it's not plain sailing. We will monitor the facts. We will monitor what's happening on the ground to see if there's more implementation like Eskom. We have a lot more to sort out. We have Transnet, as Linda says. We have the ports to settle, and we have a whole bunch of other things. But doing the simple things right, just fixing the potholes and getting our basic education right. Because all of this needs to sustain our debt. I spoke about the unsustainable potential debt in the US. We have the same problem. If we don't grow, and Linda referenced a less than 1% GDP growth over the last 10 years, we are on an unsustainable trajectory from our debt perspective. The line shows our debt to disposable income, and obviously you don't want this chart upward sloping, because that means that we're on a potential debt trajectory that's not sustainable. What we do need is almost 2% growth, and then we are in the clear as the growth is sufficient to fund the growth in the debt, which is very important to get to that sustainable level. And as I said on the previous chart, we'll be tracking the facts to see if we think that's possible. As of now, we are positioned for a slightly slower growth than the 2.5%, but we do think that it is looking slightly better over the next 5 years. So what do we do about it? I won't run all of Wim's thunder. To a certain extent, we have a very good allocation, as I said, 52% to SA incorporated shares. Bear in mind the index is on the inside of the circle. That is only equal to the benchmark weight of SA incorporated shares. So though we took the overall weight in SA incorporated shares from the 30s to the 50s, we're only at benchmark weight. So we're much more reliant on the overall stock picks that Wim will talk about as some examples to show where the differentiation will be. We still have a healthy allocation to global stocks, which are all on the screen, which are Naspers, AnBev, British American Tobacco, Aspen, to name a few. And as you can see, the cash weight is down and the resources weight is around 10%. So for us, although I said at the beginning, the large caps have started to reflect a fair amount of the election euphoria, the real excitement for us sits in the smaller and the mid-cap shares. The red bars are the forward allocation to those different sections of the market, and as you can see, we have a very big allocation to small and mid-cap shares, which we still think have significant potential for growth. I'll now hand over to Wim, and he'll dig into a few of the companies that we look at and why we look at them.
Thanks, Nick. So as Linda and Nick has mentioned, very tepid growth over the past decade, and our preference remains for companies that we believe will do well even in a low growth environment. So the first company we'll look at is Premier Foods. It's one that will be well known to most of you. It's got basic consumer goods, and the majority of their profitability comes from the bread segment, which we will touch on. So that blue ribbon bread is one of the staples within the Premier Foods stable. So why did the opportunity exist? Well, Premier Foods has recently been listed, and it's due to a forced selling by Brait. And this unfortunate chart just shows the Brait share price over the past decade, coming down from 120 Rand to below 1 Rand, so 88 cents at the moment. And when you have an acquisition spree filled by debt, then oftentimes it leads to forced selling, and you need to dispose of the family jewels. And in this instance, Premier Foods was within the Brait stable, and they had to sell down, as mentioned, from 97% to 33%. And fortunately, we were able to take a significant position at what we believe is attractive levels. So Premier Foods has been on our radar for a long time. We've spent a lot of time looking at both the business and interacting with management, and we like both the company and the industry within which it operates. So focusing on the bread segment, along with Tiger Brands and Pioneer Food, the top three players account for more than 70% of the market share. So it's a semi-oligopoly that still exists within bread. And what this allows you is high barriers to entry, so very limited potential for new players coming into the space, and it also gives us as investors good insights into the relevant players within the market. And what's been very clear to us for some time is Premier's positioning within the market. They've got both the best-in-class management and they are the best position within this space. So the top right-hand chart just shows Premier's market share within the formal market over the past 5 years or so, and it can show the 4% increase that they've seen. And if you go back further, there's been a steady increase in market share going back more than a decade. And what this has allowed them to do in the financial terms is to compound revenue at close to 11% since 2011 and profitability at 18% over the same period of time. So very strong results from the group in what has been a very soft macro environment in South Africa. So just understanding how they've been able to do this. The top right-hand chart shows the capital expenditure to sales number, and this is a proxy for the investments they've been willing to make as a percentage of their sales. And while the bottom chart shows Tiger Brands' investment pretty much just replacing whatever capital they have in the business, what we've seen from Blue Ribbon is a very significant spend on distribution channels and building out the footprint within the country, and also on their manufacturing facilities. And all of this has been done in order to get cost out of the system, improve the efficiencies, and have a broader reach and reach a broader market footprint. And it's translated into what we spoke about, the formal market, seeing very significant increase in market shares, and there they focused on the inland segment. And the new factory that they commissioned within Pretoria saw market share within that space going from 12% in 2022 to 20% in 2024. So very good traction, and we believe there's more to come within that specific portion of their market. And then on the informal market, this is where they are the leaders. So they've got 32% market share, and they have a national distribution footprint that flows into all the spaza stores across South Africa. And importantly, this is not only difficult to replicate for Tiger Brands and Pioneer Foods, it will also take a lot of time and will take significant investments in order for them to get it done. So 70% of Premier's bread sales comes from the informal market, and we think they are very well positioned to continue to grow within that segment. So what does this translate to in terms of numbers? Well, if we were to compare Premier Foods to Tiger Brands over the past 6 years, you can just see the extent to which the significant underinvestment by Tiger Brands is evident, both in terms of the top graph that shows the revenue, and here they've just been unable to adequately service their market while Premier has been growing their footprint. And the differential in top line growth is 2% compounded for Tigers over the 6-year period versus 12% for a Premier, which is a very stark difference. And then in terms of actually efficiencies within the business, both distribution and manufacturing efficiencies, we can see Tiger Brands just being far behind the curve. So the cost of doing business continued to increase, and we saw Tiger's margins moving, the red line at the bottom, from 13% in 2019 down to 3.6% in the current period. So very bloated cost base, and the reverse has been true for Premier, where they've seen a material uptick in margins, and from today they've got multiple initiatives to both support these margins and to grow them going forward. So where are we today? Well, the market's providing us with an opportunity to invest in what we believe is the best placed food producer within the bread segment, with the ability to expand and grow margins and also gain more market share going forward. Importantly, they are also over the capex hump. So the significant capex spent over the past number of years will sustain them for quite some time to come. And as the free cash flow opens up over the next few years, that gives them the opportunity to redeploy the capital to either return it back to shareholders or to reinvest back into the business, or if there's an interesting acquisition opportunity, they could take advantage of it as well. And then importantly and lastly, all of this is great, but from a valuation perspective, what are we seeing at the moment? Well, we think there's about 35% upside to our estimation of fair value, and we can see on a relative basis the company is currently trading at more than 20% discount to Tiger Brands, which is in a tough space, we believe. And on an absolute basis, you can buy this business on an 8 times forward price to earnings multiple, and we expect earnings to grow double digits from this point forward. And then importantly, we think they can deliver these values even in a low growth environment, which remains our base case to some extent. So definitely an attractive one that we've been entering into our portfolios. The next company is Fortress, which is a property play, and it's a very different type of investment opportunity versus a Premier. So this is just a chart to show Fortress's share price over the past 5 years, and you can see the property sector overall was significantly impacted by COVID, where the share price almost halved. And then the dual share structure that existed in Fortress also created issues. They were unable to pay out dividends, and as a result, they lost their REIT status, and this resulted in the share declining to a low of 9 rand. Well, for anyone simply focusing on the fundamentals of the business, this was a great opportunity. We believed that the issues were transitory, and we were able to take advantage of these very low levels. And subsequently, we saw the share price improve, and today it trades closer to 16.60 rand. So that's all great. Why do we still own the business today? Well, in very simple terms, if you were to take all the assets that exist within Fortress and you subtract the debt on a per share basis, today we believe there's around 25.40 rand per share in value that exists within Fortress, compared to a share price of the 16.50 rand. And importantly, within the stable of assets they hold, there's a NEPI stake, which is a listed property company that's worth around 11.90 rand per share. So almost half of the valuation that we believe exists within the business is a liquid listed asset. And the rump, if you were to subtract the NEPI stake, the rump is valued by the market at roughly 4.70 rand, compared to an actual valuation we believe of 30.50 rand. So the game plan is, how do you unlock this 65% discount within the rump that currently exists? So the current investment case is predicated on a few steps. The one is the unbundling of the NEPI stake, which is the grey bar at the bottom left. So almost half the current share, more than half of the current share price can be returned to investors through unbundling of the NEPI stake. The second step is slightly more difficult and will take a longer time to achieve, but it's the disposal and exiting of what we believe to be non-core assets, which in total is worth around 7.40 rand per share. So we think the Eastern European logistics assets, the SA office property portfolio, and the SA industrial portfolio can be disposed of, and after settling the debt that exists against these assets, in total, the unbundle of the NEPI and the disposal of these non-core assets, we can see around 12.60 rand returned to shareholders over time, compared to a current share price of 16.50 rand. So what remains within the business after all of this is done? Well, there's the high-quality logistics properties that we quite like with an SA focus. There's new developments coming online and a very strong growth profile from this point going forward. Then there's the defensive retail assets, which has held up very well in the current environment and continues to trade well. And after settling for the debt against these assets and applying a discount for head office cost and some of the tax payable, we think shareholders will be left with around 10.20 rand in value that will continue to trade on the JSE. So in total, adding up the NEPIs we expect to receive, the special divvies through the disposal of the non-core, and the remaining assets, we think there's around 22.80 rand on offer for investors over the next 12 to 18 months. So what's the key factors to getting it done? What usually trips investors up for when it comes to value unlock is the timing of it. So very different receiving 1 rand today versus 1 rand 3 to 5 years from now. So things need to happen fairly quickly. And that's why the NEPI stake is quite important, because it's liquid and easily unbundled. We believe it can happen quite quickly should management proceed. The margin of safety, well, that is, we'll look at various scenarios and try to determine the value that exists within the business. Should nothing happen, should there be partial unbundle, or should there be full execution of what we believe the value unlock opportunity is. And then the last and the most important factor is incentives. So it's incredibly important to align management's incentives and remuneration towards this strategy. So it's a difficult ask for management to reduce the number of assets under their control, and you usually find that a mismatch of incentives doesn't result in execution. And within this regard, this letter shows just a snippet of engagement we've had with the board. And it was signed by a significant cohort of shareholders, and within this letter, which is dated on the 15th of July of this year, we explained to the board and to the management the value unlock opportunity that we believe exists. We touch on capital allocation and the best way to proceed forward to create value for shareholders. And lastly, we give our view on the remuneration policy and how we can align management's incentives to ensure that they are properly rewarded for taking these steps. And our initial engagement has been positive, and we think there's a fairly high probability of at least a partial execution of the aforementioned plan. So how does this play out in various scenarios? Today's share price, 16.60 Rand. We think if nothing happens, then the fair value is closer to 17.80 Rand. So there's about a 7% uplift to the current share price. And importantly, from that level forward, we think the fair value reflects an adequate return for shareholders going forward of about 14% per annum. So that's the way to think about the status quo, 7% uplift. If there's only the unbundle of the NEPI stake, we think there's about a 22% uplift to fair value to 20.30 Rand. And if they were to listen and execute in full, both unbundle the NEPIs and exit all the non-core assets, then we think there's around 22.80 on offer that can be unlocked to shareholders over the next 12 to 18 months. So all in a very attractive risk-reward proposition for us. And again, similar to Premier Foods, we believe that this value can be unlocked and delivered to shareholders even in a very low growth environment. So with that, I'll hand back to Linda for Q&A.
Thanks very much, Wim. So let's take a look at some of the questions which have come through. I'm going to start by delving a little bit more into the South African equity space, and then I think we can broaden out the discussion to include some of the multi-asset funds as well, and our positioning in those funds vis-a-vis South African equities. I'm going to start with you, Wim. One of the questions that was put through is, should we be concerned about the delisting trend from the JSE by South African companies? Of course, we've seen quite a shrinking of the opportunity set over the last 10 years. Is that something that concerns you as a portfolio manager looking at that opportunity set? Has it affected your ability to find opportunities?
Yeah, so the delisting trend's a function of low growth in South Africa and then also the low valuations we are currently seeing. And from a selection perspective, one can argue it's negative as these companies get removed from the JSE. But from an opportunity perspective, it's validation of some of the low valuations we believe exist, and we can actually partake in some of these delistings. So we're fortunate that at the moment, we are not encumbered by lack of selection. In fact, our debate is more robust around how can we add new opportunities that we are finding into our portfolio. And as we've seen with our cash holdings coming down, we are finding quite a few at the moment, which is a great place to be.
So, of course, yes, we have been able to deploy that. And I think it also speaks to timing, doesn't it? So hopefully if things turn around, we'll see a reversal somewhat of that trend, hopefully.
Yeah, if we see the valuations react and some growth coming through, then the animal spirits can be fairly quickly. The international investors can come back into South Africa. It's all about getting to a place where there's investor confidence and people are willing to take a 10-year view, which in the current political environment, I don't think we're there yet, but it's something that can definitely happen over the next while.
Nick, I'm going to ask you a question. Someone cynically asked, how are things going to be different with mostly the same old faces in cabinet? Perhaps you could just speak to, in greater detail, some of the markers that we actually will be watching with regards to, rather looking at what they do rather than what they say. What are some of the things that we'll be watching with regards to how that cabinet actually affects change?
Yeah. I did speak about it a little bit earlier, and I think I largely answered that question, but I do think that that's the best way any investor should be. I think it's important not to be emotional. It's important to not get over euphoric when something feels good and you see the change. It's important to not be overly depressed. We need to be guided by the facts. So we will be led by what execution happens on the ground. And as I said, the easiest one was the Eskom example. Let's see what they do. The ports need to be fixed. The trains need to be fixed. We need to be able to educate our people so they are employable when they come out of school. These are the sorts of things. I think the Home Affairs stuff is important to make sure that skills do come into the country because we lack key skills to execute some of the fixed capital formation that we need to do. So I think all of the above is just watch what happens. yeah, we'll be judging based on execution.
And I think some of the structural reforms we're looking to see will be watching things like Operation Vulindlela, seeing the progress there, of course.
Yeah, it's easy to put out a statement, and I've always said big, bold statements sound great, but let's see how they implement them.
Yeah, making it easier to do business in South Africa. Wim, I'm going to move back to something that obviously affects everybody, not only as an investor, but also as a consumer and as people who have debt. Most of us have debt. Let's talk about the interest rate cycle. We have seen recently that there may be a bit of a glimmer of hope that rates might be cut further this year. What are your expectations with regards to that, and how might that actually influence asset prices?
Yeah, so at the latest NPC meeting, we actually saw a split vote in terms of 2 out of the 6 voting for a cut, which is the first split vote in a while. Our expectation is very much in line with what is likely to transpire in the US as well, which is a 50 basis point cut by September. This has the benefit both in terms of your disposable income increases, and people with debt will have more free cash flow that can go towards consumer spending, etc. And then as interest rates comes down and your long bond yield comes down as well, your discount rate is also reduced. And all that simply means is that asset prices tend to move upwards in line with that. So we believe it's positive for housing prices, positive for asset prices, locally listed equities, and from a consumer perspective, it will also provide some much needed relief.
Somebody also mentioned the introduction of the two-pot pension system. It's something that is due to be effected on the 1st of September, so I think it is something that certainly a lot of investors are concerned about in terms of what it might pull from the market in the short term. But I suppose the other part of the equation is, where's that money going to go? Your views on the introduction of the two-pot pension system, is it likely to have a significant impact, or is it much ado about nothing, do you think?
Yeah, we think overall it can maybe people will access around 50 billion rand, it's a significant portion. It will be a once-off as they tap into their pension money. Some of it will go towards discretionary spend, and it will be positive for the likes of some of the retailers. And then some of it will go towards settling debt. So potentially a positive impact on some of the credit loss ratios we see within the banks. But the way we think about it, we tend to look through any short-term blips and try to focus on what we think is a sustainable earnings for the businesses, and not much changing in terms of that.
Importantly, one thing I'll add to that is I think it's a well-intentioned plan, right? I think there's a lot of talk around, whether it's good or bad for the country. I think long-term, actually, it's a good thing, because there's far too many people resigning, cleaning out all their savings, and then only realizing afterwards. So restricting 2/3 through time, I think through a forced saving is a much better way of doing it. It does mean that in the first year, as Wim was saying, there will be a fair amount of outflows from the savings scheme. But I think through time, I think there's a crossing point. Some people talk about the 6th year, the 7th year, some people talk about the 10th year, but there will be a crossing point where the savings pool will be bigger with the two-pot system than without it.
So, Nick, let's extend our conversation a little bit across the multi-asset class spectrum. Obviously, you manage some of the funds which have to allocate between South Africa, global equities, South African bonds, global bonds, property, and the likes. If you compare South Africa versus other potential equity opportunities around the world, how would you sort of compare the opportunity in South African equities in comparison to, for instance, global equities in developed markets?
Yeah, I think it's important, because that's how you benchmark anything. We do it on a stock-by-stock basis. We'd benchmark South African retailers and look at, what a overseas retailer would be. And I think, importantly, all the things I said means that South Africa is looking better. But to be honest, there's still a lot of good opportunities in the offshore space. There's some Chinese companies that are at significant discounts to the South African stocks that everyone talks about how cheap they are. So I think on a stock-for-stock basis, there are enough good opportunities offshore, there are enough good opportunities in South Africa. The way I spoke about the cash level in the overall forward equity fund, it was similar to the overall forward balance fund. What we did was we were around 44% offshore in the balance fund pre-election, around about the election time when the decisions were being made, we did bring back money. And we took that 44% offshore down to 40%, acknowledging all the things that we spoke about, the tactical near-term opportunities. I think subsequently, because of market movements, we've come down to around 39%. So absolutely, it's a fine balance between these items. You need to make sure your overall portfolio is balanced and not bet the farm on the one view or the other view. So I do think that putting it all in one pot I think there are enough opportunities offshore. There's some really interesting ones in South Africa, and it comes down to stock selection at the end of the day.
Now, Nick, you mentioned Chinese equities. Of course, we do still hold a big position in Naspers and Processfirm within the Forward Equity Fund. Obviously, a lot of that is premised in what will happen with Tencent. But could you just speak to how we see that opportunity playing out? We obviously still have a positive view there. Are there any dynamics which are specific to Naspers Process outside of Tencent, or is that really the majority of the upside? So just if you could just give us an updated view on that, please.
Yeah, so there's a few components towards that holding. So the Tencent is about 85% of the value, that the assets that sits within the Naspers Process stable. And there we believe there's maybe another 20% upside, perhaps slightly more, depending on how things play out in China. And then the other assets that sit there, importantly, they've gone through the J-curve and has recently turned profitable. So that's a very positive development that we believe has got legs to it. And then overlaying all of this is both Tencent and the Naspers Process stable are doing buybacks, which adds significant value to shareholders over time. And it's a very powerful value creation tool for shareholders. So overall, in addition to it playing into our exposure within China as well, which forms a component of how we view the holding, but we remain very constructive on the opportunity, and it remains a very large position within our funds.
Now, I see there's a question that has just come through from our audience live, which I'm going to put through to you, Nick. It's basically asking about de-dollarization. How would the de-dollarization affect offshore investments that are US dollar based? And this is something I know we've discussed a lot in the investment team. So your views on de-dollarization in general?
Yeah, I think it's very topical right now, the whole thing around the BRIC currencies, etc. I think what's happening, and one of the reasons we are kind of keen on gold, is one of what's happening is a fair amount of the countries outside of the US are saying maybe we shouldn't keep all our reserves in the US dollar. So I think the initial stage, is going to be savings. You're going to see the Chinese and other countries like that reinvest some of the excess savings instead of in US dollars into gold and other things. And we have seen a substantial amount of that. I think when it comes to transacting and true de-dollarization, you haven't really seen, you've seen at the margin a bit more Chinese currency, the RMB, a little bit more other currencies being used for trading, but it's still a very small amount from a transactional point of view. The last thing is that, and it's something we need to think about, I think Donald Trump is a lot of bluster, but at the end of the day, some of it does come through. He is talking around a 10% tariff across the world, not country dependent, with additional tariffs potentially on China, even more so. At the end of the day, that could lead to more deglobalization, and it could kind of dislocate it a bit further. So there are a lot of moving parts. I do think that it's being overplayed slightly, but at the end of the day, it does come down to, can the US sustain its debt burden? Because when we forecast out 5 and 10 years' time, we do think that there is a risk that they aren't self-fulfilling from a debt point of view. So it's very early stages. I don't think it's something that we've got to get too worked up about, but it's more of a long-term theme, probably closer to 10 years than 2 years.
Well, it wouldn't be an investor webinar if somebody didn't ask about our view on the rand-dollar exchange rate, but I think they've asked specifically with the context of Donald Trump as potentially, it looks like most likely, the next US president. What does this mean for the rand-dollar exchange rate? I suppose perhaps you could just also give a view about where we think it's trading and what bands we think it's likely to stay in.
Yeah, I think it's one of those things that the rand will be defined by the buyers and sellers to a certain extent. So one of the things we haven't had is the foreign investors. The foreign investors have withdrawn a fair amount of money. So there's two different parts to a currency. The first one is how much do we export and how much do we import. It's actually been quite resilient. We expected it to return back to a trade deficit because the PGM prices haven't done well, the platinum group metals. We've also seen coal and iron ore and all of them come down, combined with the port issues, meaning we're exporting less volume also. We've been saved by some of the smaller metals like chrome, actually weirdly enough, has added to the positive trade surplus. So at the margin, I think we've been positively surprised at the trade surplus, and obviously the counter has been that some of the foreigners have started to dip their toe back into South Africa post the election, which has meant there's been a bit of flow of money back into South Africa, although it's relatively small. So when it comes to fundamentals, I do think that the total current account is the scorecard to define whether the rand is cheap or not. I do think we're still running a relatively sizable current account deficit. But for kind of numbers, always people want numbers. I think in the 18 to 19 rand dollar, we're talking about a rough fair value that we work with.
And then, Nick, we've also had a question on copper. I mean, copper has been something that's been spoken about a lot, given potential electrification and the green energy transition. Can you discuss a little bit how we view copper, whether we have any copper plays within our global portfolios, which I know we do. So perhaps you could just elaborate a little bit on our view on copper and how we see that playing out as well, please.
Yeah. Listen, it's one of the metals for the future. I think it's the one reason that Billiton tried to buy Anglos. Interestingly, you saw them not wanting Amplats and not wanting Kumba, but they really wanted the copper assets, right? Billiton are on a trajectory to try and increase the copper and to reduce the amount of iron ore within Billiton. And the reason for that is there's just no new mines coming out in copper. It's quite easy to see the 10-year plan for supply because it takes 10 years to get the environmental approvals to actually put the infrastructure in place. And there are very few new copper mines coming out. Importantly, copper is used not only in electrification of cars, but also in renewable energy, both from the wind farms and anything to do with renewable energy, to be honest. So copper is looking, and we've said it a few times, there's no surprise, that the demand is going to outstrip the supply. Where do we own it? Obviously, we have a small holding in Billiton and Anglos, although the other metals within those businesses are a bit more of a concern. In our global fund, Freeport McMoran continues to be a top holding. It's a 100% focused copper business. It's one of the only copper businesses with volume growth, and I think it's a business at the lower end of the cost curve also. So for us, it does come down to the particular metals, and copper is one that we're very interested in.
And then last question, Nick. This is one that both of you are willing to contribute to. It's not one that we've got concrete answers to. But, you know, looking at the political backdrop that we face globally, I mean, there's a lot going on. It is the year of the elections. Many countries having their elections this year. And we've seen some marked changes in many governments. I mean, India also has now got a sort of equivalent of government of national unity. Their majority party also lost the majority rule. There's also been a lot of shift towards more centrist policies, a bit of a step away from kind of the radical left. What do you think the impact of all of these shifts is going to be on global markets? You know, deglobalization, potentially inflationary impact. Some of your thoughts just from a big picture perspective on what we're seeing in politics around the world.
Yeah, listen, it's not an easy one to opine on. I think the interesting thing for me is some governments have shifted to the left, others are actually shifting to the right. It comes down to the finer detail who runs the place, but there's a movement on both sides. I think the largest explanation would actually be that the masses are voting against the incumbents. So when there's a kind of lead on the right, they want the left, and when there's a lead on the left, they want the right. People feel not happy. They want change. They want things to be better, and it's always whatever's there is the problem. So I don't think we can say for sure that there's a definite shift clearly across all the countries to the left or to the right. And I think it's just natural stuff that we need to deal with as investors. I don't think it's any more different. I mean, they always make it sound more extreme in the newspapers, but it's not more different to deal with than any other time that I've been in markets. I don't know if you've got anything to add on that, Tom.
Yeah, maybe the most pronounced thing at the moment is the increase in geopolitical risk as we move forward. So if we do see severe action by Trump in terms of NATO that actually dismantles the umbrella of protection that's existed for decades and that's often taken for granted, it's very difficult to predict how that plays out going forward. So that would be something we watch very closely. But yeah, I'd agree with Nick. The risks are always there, and they just pop up over time, and you deal with it. But nothing untowards or out of the ordinary.
All good reasons to hold gold.
But I'll add one more thing. I think, like with most things, when it comes to a company or a country, debt multiplies the impact of any good or bad outcome. And I think that's the worrying piece, is that, you know, we'd always be cautious of a company that had too much debt because it's a magnifier. Countries these days are operating with too much debt, and that's the bigger issue, that the geopolitics plus the debt adds to the bigger variability of outcome.
Yes, and that is something that we've seen around the world amongst emerging and developed economies, is that rise of government debt. Unfortunately, those are all the questions we've got time for. Thanks, Nick and Wim, for a very interesting discussion. And thank you to everyone who's posted questions today. I'm just going to give a very quick summary of some of the key points before we wrap up. So first of all, Nick spoke about Trump 2.0, but in particular that Trump is inheriting a very different set of circumstances than he did in his first term, assuming, of course, that he does become the next US president. The reality is that his first act will be tough to beat. The US consumer is in quite a strong position. Nick showed that their net worth is up considerably thanks to the rises in both the stock market as well as the housing market. But there's very little fuel left to power that economy further, and the wealth effect is likely to fade. So if you look at government spending levels and deficits, there's very little more that they can really sort of do to actually keep that economy going. And as a result, we do think that there will be tepid growth from the stock market, considering how high valuations are at current levels. Turning to politics in South Africa, we've recently seen some very positive steps in the right direction, but we will be watching the results and the stability of the government of national unity. So it's about watching what they do, not just what they say. There's a lot of water to go under the bridge. Certainly parties having to work together with very, very different policies, but hopefully that'll move in the right direction. Suffice to say that things could have turned out a lot worse, and hopefully it'll be of comfort to our investors to know that we always consider the worst case scenario, and we make sure that we have protection in portfolios for that outcome, even if it is a low probability outcome. Energy supply moving in the right direction has been a very strong positive. I think Nick showed how the energy availability factor has improved markedly, how this year is faring a lot better than last. We're sitting now to close to 120 days without load shedding. That's almost a third of a year. And economists have estimated that if we have no load shedding for the entire year, that could actually add 2 to 3% in economic growth. And certainly we've seen an uptick in confidence and sentiment, which has driven ratings. That means the price that the investors are willing to pay for the underlying earnings of the businesses. But what we really want is a backdrop that allows those businesses to grow their earnings sustainably. So coming off a low base, there is a lot to be excited about, but one does need to be measured and think carefully about the types of businesses that one is invested in, because there are still going to be winners and losers regardless. So it's important that we do our homework on that score. And Nick spoke about how we're using the full opportunity set to hunt for those opportunities. So not only do we have a lot of the high quality, large cap companies in our portfolio, some of which get their revenues from outside of South Africa, which is also a very important hedge against things not turning out well in South Africa. But But we do also have some really fantastic small and mid-cap companies in our portfolios, many of whom are still priced to deliver considerable upside from current levels. Vim gave us two very different examples of the types of opportunities that are making their way into our portfolio. Hopefully, you got to see that there is significant amount of work that's done with regards to considering the quality of the businesses that we invest in and the value of those businesses. So we're always considering the future earnings streams of businesses and then comparing that to the price that the market is asking us to pay for those businesses and making sure that those two things stack up. So he spoke about both Premier Foods, a high quality business, does have some defensive exposure, as well as Fortress Real Estate, how these opportunities came about, what we're watching with regards to those businesses. And again, this is really just to give you some color around the bottom-up element of our investment process. So how we actually do that valuation-driven work to populate the portfolios with those investments. Hopefully Nick's section has given you a good idea of how we're thinking about some of the top-down themes and how that actually impacts how we're positioning our portfolios. And Vim's section hopefully has given you confidence about the fact that we have considerable depth in our resource team and that we're really able to delve deep into those investment opportunities to make sure that we have a good combination of investment opportunities across the board. That's it for today. There is a survey that is going to pop up when you close the session. It's going to ask for your input on how you found the session, but we also would be interested to know how you want to receive content from investment companies like Ford. So please do give us your input on that. We obviously want to make these sessions as productive as possible for you, but we also want to make sure that you get the information that you need from us as a business. Thank you, Vim and Nick, for your contribution to the discussion today, and thank you to everyone who has joined us.